And welcome. This is Mary Ellen McGonigal with your Friday afternoon MEM Edge show. And of course, this is the show where we bring you where all the action is in the broader markets. We're going to take a look at some of those headline news that drove price action last week. Also, take a look at where we closed the markets for the week. Not a very constructive period. All of this with an eye toward preparing you for not only next week, but beyond. So let's go ahead and jump in. Take a look at some of those news items last week. We did see a continued escalation of the conflict in the Middle East. In turn, oil and gold prices surged. We also did see yields on that 10-year treasury, and it just got up above 5% today. Pretty big impact, particularly on growth names and elsewhere. Earnings season front and center. Most of your biggest movers to both the upside and the downside were earnings related. We're going to take a look at some of those stocks because, as always, what often takes shape is other stocks in that group experience similar price action. We also did get a September retail sales number, and it came in ahead of estimates. And that was another negative, certainly for the interest rate scenario, in the sense that a higher consumer base, which comprises most of that GDP number, is going to keep interest rates elevated. We also had comments from many, or certainly several, Federal Reserve governors and Fed Chair Powell in particular. And the sentiment there was that we may well see continued tightening and in turn continued elevated interest rates because inflation is sticky. We are seeing the economy remain fairly elevated, enough for concern. And the Fed's all about getting to that 2% level, and we're just not making that progress swiftly enough. So in turn, we'll take a look at the impact there. Housing starts rebounded in September, surprisingly, but it was also another positive notice as it relates to the economy. And we also next week are going to get very highly impactful inflation data. We're going to get core PCE data. We're also going to get that first estimate for the third quarter GDP. That's going to be closely watched. Always, we don't want to see a whole lot in way of growth as it relates to interest rates. And then we will get durable goods orders next week as well. So a lot taking place last week and next week, as well as earnings season really begins to pick up. So let's take a look at those markets and see where did we close for the week. And here we are with a daily price chart of the S&P 500, and not very constructive looking. Let's take a look at some of those metrics that point to potential further downside ahead. First up, we do have this relative strength indicator. That's one of several momentum metrics that I use very regularly. And it did close last week in positive territory. However, we are now in negative territory, trending lower. We also had stochastics today turned into negative territory. This is a faster moving momentum indicator, and you can see it closed below that 50 level and it lower. And most importantly is the fact that the S&P 500 closed below this key 200-day simple moving average. This was that last line in the sand, if I may, in the sense of looking for near-term possible support. And we did, in fact, close below that. Pretty high volume on this selling as well, indicating distribution. As we move through, you'll see where this negative investor sentiment is emanating from. Now, from here, what we need to do now is look at prior periods and lows for potential support. First up is going to be this late May area, and it is very close, but from there, again, looking at prior lows for potential support. And this is not what we wanted to see with this close below that 200-day. But let's go ahead and take a look at the Nasdaq, of course, a very key component of these markets, one that certainly led us to new very good gains, solid gains here earlier in the year. And at this point in time, you can see similar metrics with that RSI in negative territory, heading lower, likewise with the stochastics, and again, elevated selling or volume on that selling as we continued to progress. Now, at this point in time, the Nasdaq did close at 12,983, and that is below that 13,000 level, which is widely viewed and watched. So we'll see. It is only nominally below it, but is it enough to spook investors and see so that we may see further deterioration? Now, I will say this RSI is quite low. We're getting close to that 30 level, and I don't anticipate that we will get into an oversold. That's not something you see quite often, but of course, next week will tell as far as where these markets head, but we are closing the week certainly with a negative bias. Now, one other chart that I did want to share with you is taking a look at the Nasdaq and the S&P relative to interest rates. So before we do that, let's go ahead and jump back to that S&P, and I want you to follow along here. We can see that we had the markets back here in May stabilize with the S&P and then elevate into a very nice uptrend into the end of July. Now, from here, we're going to take a look at interest rates and also volatility. Volatility has really gone up. In fact, I'll just go ahead quite quickly here and share with you a chart of the VIX, also known as the fear index. And you'll see that it has gotten up certainly above that 20 level, and we are now at almost 22. So you can see this elevation taking place in the VIX, which is a not great backdrop for the markets. Now, from here, I'll share with you the relevance, and we're going to go ahead and take a look at that yield on that 10-year and go back and take a look. I'll walk you through this at that period when the markets stabilized and then entered into a very nice uptrend May into August. First up here, two lines. The first one that I will share with you is that yield on the 10-year Treasury. And then I've overlaid the VIX, the volatility index, on top of that. So if we go back to these prior periods, certainly the real uptrend began in the markets in May, and we can see at that point in time, volatility was up here in around that 18 level. And from there, we did see the markets advance. So at this point in time, we are well above that at that 22 level on that volatility index. However, using that as a metric for a potential rally, given the spike in volatility, one key metric that is very different is this yield on the 10-year Treasury. So back here during this stabilizing into an uptrend period, that yield on that 10-year was down at about 3.3%. At this point in time, in fact, today, we did dip just above that 5% level briefly, but certainly quite a bit more elevated. The bottom line is that this interest rate backdrop is going to be that driver as it relates to price action in the markets. It just impacts far too much. And as we move through today, I'll share with you where the heavier impact is going to be, certainly from this currently high interest rate and the fact that there is more of a sentiment that we will remain elevated for some time. So let's go ahead as usual. We're going to take a look at the underlying 11 sectors in the S&P 500. We want to get a sense of where there may be something in the way of relative outperformance. And then, of course, those really weak areas as well. First item of note is the fact that we are down to one sector that is remaining above its 50-day simple moving average. Let's take a look at XLE. I talked about that spike in oil prices. We also had other factors impacting this industry group. And by way of earnings, I'll share with you certainly a bellwether name that did report. But we are up here with XLE above these key moving averages, MACD trending upward for those of you that are feeling nimble and want to participate in that energy group. It certainly is near-term positive looking. From here, we'll take a look at communication services. Heavyweights here are Alphabet and Netflix. And Netflix, of course, a big winner this week, but was not able to stem this negative price action here on XLC, closing just below that 50-day. Now, I will tell you, XLC perhaps as we get, actually, we will take a look at the performance of this industry group, and it really has been outstanding this year, but we are seeing negative. Now, we have other periods here with XLC where we dipped into negative territory with this sell-off back here in late August. Again, September. So it's not overly alarming. It's more something of note. So moving along, technology now in negative territory, negative RSI and MACD. This is XLK, and we'll share with you where that negative performance is emanating and what is driving technology lower, and certainly higher interest rates. This is going to be, in fact, communication services and technology are going to be two of your higher growth areas that are going to be the most negatively impacted from an elevated interest rate scenario backdrop. Now, let's take a look at some of these defensive areas that have been down in this lower quartile. They're beginning to move up, but it's not anything to get excited about. We had a little bit of a rally here. A major pharmaceutical company, I believe Pfizer, came out with good numbers, was able to bump this area higher. Also, some medical products stocks also traded higher this past week. And from here, let's go ahead and take a look at some of these other areas that are down now in this lower quartile. And as stated in the beginning, most of your bigger movers were earnings related. We can take a look here at financials, XLF, and certainly deterioration into the end of the week. And from here, I will tell you that a number of bank stocks came out with numbers, large and mid-sized, and they were not good. This high interest rate environment normally would be good for banking stocks, but it would make sense if we had a nice spread with the yield curve, and we don't have that. So higher interest rates may reduce lending activity, in fact, but more to the point this week is the fact that these earnings were below estimates and these banks are seeing deposits being reduced. I'm believing as investors, or certainly as consumers, are moving towards some of these higher yielding funds, whether it be treasuries or otherwise. Also, we can take a look at another area here that was beginning to turn positive and then did turn negative into the end of the week. This is XLI. Certainly that rise in interest rates, the rise in the US dollar as well. We'll take a look at that as we move through. And a number of these large staples companies are going to be negatively impacted by a rising dollar because it will reduce the value of their revenues. And also, we did see earnings from a couple of these bigger names, and they were not particularly spectacular. So let's go ahead and move forward, take a look at some of these sub-industry groups here in the broader markets. And I'll share with you again, strength to weakness. I use select ETFs that are really quite helpful as far as getting your arms around where the strength is. What that impact may be is up to you to do the work, but certainly something that I'm very tuned into. First up here, we talked about that spike in gold. This is that safe haven security, and we can see this very sharp advance up here. And in turn, we did see other metals stocks trade a bit higher, but certainly not to the extent of gold, which was up almost 3% on the week. Here we are with that yield on the 10-year. You can see it got close to that 5% level before pulling back. And also, as we move through, I will share with you this US dollar view. And the US dollar was mostly flat for the week, up about 0.3%, but still certainly elevated relative to nominal levels. We need to go back to this period at the end of 22 to see the dollar at heights that where they are now. And then moving through, taking a look, I talked about technology, negative price action there. And we can see two areas here that were up more at the forefront, but they're beginning to deteriorate. We can first up take a look at software stocks, IGV. And here we are with the move below each of these key moving averages, that RSI 50 and trending lower. Now that MACD rolling over. Not great news because certainly this was that one last area in technology that was holding in well. A couple of factors here as we move forward. I'll share with you what drove that negative price action in the software names. And of course, in my MEM Edge report, I will talk further as far as the outlook going forward and other key metrics. Up here now is semiconductors, SOXX. And this is an area that had been really displaying relative weakness. We had this pullback here in the beginning of August, a rather feeble rally attempt, another pullback, and a couple of metrics and reasons for this week's decline. It was down over 4%. You can see your momentum here in negative territory. And certainly earnings was one driver. Also, the fact that Biden is going to be tightening as it relates to companies, US companies supplying chips to China, not all chips, but certainly Nvidia's chips. They were very negatively impacted by that news. And then as we move forward, I talked about the bank group getting hit down 4% on the day. This is not what you want to see if you're on the lookout for a recovery in the broader markets. You want to see a nice, healthy broadening out among these bank stocks, lending activity, more vibrancy, and we're just not seeing that. And really, that is, I can certainly share with you the view of small cap stocks. They were down 2.2%. Not as much as the S&P and the Nasdaq, but still very much in a deteriorating phase. This is another group that if we are in a period of economic expansion, healthier period, you will see small caps thrive, and we are not seeing that. From here, I did talk about, I'm going to share with you using StockCharts.com, taking us the long way, but I want to share with you a look at these S&P 500 sectors. And this is a different view relative to their performance today. We can take a look at over the last week, some of these areas that got hit a little harder, but I'm going to broaden out a little bit from here and share with you. This is over the last 4 weeks, XLC, communication services sector is flat. And then as we move out, I'm sorry, I need to develop that a little more. It is flat relative to deterioration elsewhere in these broader markets. Tech holding in really relatively well over the last 4-week period. But what I did want to do is zoom out 6 months, take us back to earlier this year and take a look. Communication services up the most relative to technology. And then also on that 3-month view, energy snuck in there, but we do see communication services positive. The reason for that is primarily going to be due to those mega cap names. Certainly Alphabet has been a nice outperformer this year. So let's go ahead from here. I talked about earnings season and why. What I will share with you is, of course, what many of you may already know is why you should not buy ahead of earnings. But first up, we're going to take a look at some of these stocks that were very negatively impacted with earnings last week. If you are not sitting in front of your screen for the entire week, you may not know that Tesla gapped down in response to their earnings and then has now broken below that 200-day simple moving average. And for those of you that may be a believer in this stock longer term, you will want to note that we've broken 200-day simple moving average. We do have that high volume characteristic and that MACD now in negative territory. Again, longer term investors during this period will want to key in on weekly charts for a bit more by way of guidance. And here we are with Tesla, MACD still up here in positive territory. It does have that predisposition to have these big drops and eventually recover. I will, again, in my report, be reviewing what you need to see in order to know that this downtrend has ended and potentially could be reversing higher. Let's take a look at another bellwether name, certainly in its industry group, that came out with earnings, and this is JBHT. And the company is, of course, a major trucking company. And we can see this is certainly a candidate where you may, going into earnings, think that, and in fact, the chart was constructive looking. We can see a nice double bottom formation. The stock broke above each of its key moving averages, positive RSI, positive MACD, and of course, their earnings were not constructive, and you can see this sharp sell-off that ensued from there. Another company that did come out with earnings, and this is going to be negative in line with a peer stock that was one of the first to report earnings, and that is United Airlines. We did see Delta. We'll just take a quick look at that. They reported a couple of weeks ago, and these airline stocks are suffering. They're just not seeing the traffic and the load factor, or certainly a lot of empty seats. And here we are with UAL. And this is another concept to keep in mind. A lot of investors feel that that these stocks will get cheap enough and that you can, in fact, be a buyer on the dip. But in actuality, until you get those metrics turning positive, you just are not paid to enter the names. You need to go back to periods such as this May rally, get those momentum RSI, MACD up into positive territory, so that then in turn, these shorter term moving averages can trend higher. At this time, as the moving averages trend lower, you're finding upside resistance at lower and lower levels. Another company, and I talked about those bank stocks, but we can take a look at a rather large name, mid-sized bank, and this is Fifth Third Bancorp, FITB. And again, this big drop down 6.5% today after releasing numbers that were not constructive. But again, there are investors that may have gotten potentially intrigued because that RSI briefly entered into positive territory. The stock appeared to be progressing toward an uptrend, but not so. And then, of course, the stock did get hit. All the news not negative. Certainly, we can take a quick look at Netflix, and that was one of the bigger winners this week. Here we are with this stock gapping up. They came out with subscribership numbers that were ahead of estimates, super high volume. The stock is now up above that 50-day simple moving average, RSI in positive territory. Now, we do have that positive black line up through the red on that MACD, not quite in positive territory yet, and we're just clinging above that 50-day. Now, from my work, certainly the broader market backdrop is going to override any certainly feeling that you could buy the stock here because it had that gap up. But given the backdrop with the markets, I would tend to stay away. Also, AT&T came out with numbers ahead of estimates. The stock did initially have a gap up into a base breakout, big volume. We do a positive RSI, positive MACD, but take a look at what took shape today. And this is in line certainly with the markets. It did have a continuation rally that fizzled into the close. This is a negative candlestick formation here. And then, of course, we do have possible upside resistance with that 200-day simple moving average. But I did want to point out that something that occurs really every earnings season is when you see a stock report, oftentimes you will see sympathy bullish moves. And this is Verizon, and not overly bullish, but certainly trending higher in response to AT&T's strong numbers. Let's take a look at some of these other stocks that also were looking fairly tempting going into earnings, but really got hit. And this is Zion Bancorp. And this is a name that I had added to our MEM Edge report back here in July when the momentum shifted into positive territory. We got that RSI and that MACD trending upward into a very nice uptrend. And then as it found resistance in this area, we did remove the stock. But more to the point here is the fact that we dipped above that 200-day simple moving average. We did have positive momentum going into those numbers. However, they did disappoint, and you can see the sharp sell-off that ensued. Now, I also wanted to mention to you, as far as putting together your watch list, certainly given the deterioration that we've seen throughout the markets, within sectors and industry groups. The big concept, or certainly what I'm on the lookout for, is potential downtrend reversals. So we can take a look at a couple of names you are going to want to do with your watch list. Take a look at stocks that are bucking the downtrend that's taking place elsewhere. Now, will Darden restaurants be my top pick? Probably not, but this is more certainly for educational purposes. Again, that fact that the stock is really rallying in the face of deterioration elsewhere. We also are coming out of a very oversold position, so that when the stock eventually does have bullish metrics and when the broader markets get back on track, you will have more of a push behind it. So at this point in time, we did have that MACD crossover indicating a new uptrend, but we have a very ominous roadblock up here with this 50-day. Another name that we can take a look at, it's in that same industry group, but it's also viewed as a defensive stock, and this is McDonald's MCD. And you can see just how it's really fallen out of bed, very oversold with that MACD, and we just almost got that RSI into positive territory as we began breaking above the 10 and that 21-day simple moving average, black line up through the red, indicating a new uptrend. So we also do have that RSI close to entering positive territory. When I'm looking at names such as McDonald's and areas that are a little more defensive, certainly discount retailers would fall into that. McDonald's, as well as ROST stores, and certainly 6 other names, were the top 8 performers during that 2008 recessionary period. They do have that ability to potentially outperform. There has been talk of a potential global recession, certainly as we have strife in the Mideast continue to expand and oil prices remaining elevated. ROST stores, we can see they came out with earnings back here, gapped up, and then did sell off with the broader markets. Earlier this week, they were able to break back above that 50-day simple moving average. I talked about this in my Wednesday midweek MEM Edge report. However, despite the stock technically being in a buy zone, I advised not to enter the stock simply because, again, that backdrop in the broader markets is really not going to support that. Let's take a look at another stock. It's not going to be the best looking chart, but we can look at it from a point of view of a company that did come in ahead of estimates. This is Abbott Labs, ABT. You can see that gap up above these moving averages, and that MACD enter into positive territory with the RSI coming out of an oversold position, but we still have a lot by way of negative downward trending longer term moving averages that could easily act as resistance. And net, this is not a very attractive or certainly tempting looking chart. Now, I did want to share with you a view of the larger cap, mega cap names, and I'm just going to take a second here. I have it set up already. And from here, we're going to take a look at these charts, because what took shape this week among these stocks is very relevant. They had been holding in well, outperforming week after week, but not so this week, a lot by way of underperformance. So again, I have these stocks set up, and then with an RSI, a 2-month daily price chart view, and then relative performance here on these big cap names. And you can see that I talked about XLC Communication Services and the fact that Alphabet really has held in well relative to the broader markets, certainly going back to the beginning of this year. So you can see this particular stock has pulled back to the 21-day simple moving average, and it was down 1.2% for the week relative to the S&P down 2.4, the Nasdaq down 3.2. What I also wanted to share with you or remind you is that the company is due to release their earnings on Tuesday. And it will be very interesting because there was a lot of anticipation that Alphabet's advertising fees have increased quite a bit. There was a lot of excitement around this number, and now with the broader markets, and certainly the chart is holding in, but it will be very closely watched. Let's go ahead and move forward, take a look at some of the other stocks on this list. Microsoft also outperformed, down 0.3%. Nice sideways price action. They're due to report their earnings later this month as well. And then another name that we need to look at is Apple. The stock lost over 3%. And you can see their momentum metrics have now entered into both the MACD and the RSI into negative territory. Now, I don't have it listed there, but let's go ahead and take a quick look at Nvidia. This, of course, is a bellwether AI name and semiconductor stock. And on that news with Biden reducing or certainly restricting the eligibility of select chips to be shipped to China, Nvidia was the highest impact. It really is going to impact their revenues by, I believe, 10%. So let's take a look. The stock broke below this 50-day simple moving average. We now have our momentum in negative territory, heading lower, and very high volume on that selling. So near term, looking not quite as constructive with this stock. I talked about IGV and software. I think we still have a little bit of time here because I was going to mention with software a couple of key elements. I'll just share with you two stocks. First up here is Okta. This is a major name in that software security space, helping companies certainly try and prevent cyber attacks. And the company experienced their own attack where their files were impacted or, they were infiltrated. And we can see this huge sharp drop, heavy volume, momentum shift into negative territory. From there, we did see a number of other software security stocks which had been holding the group up. They did get hit. One other name that we can take a look at, a bellwether, well-known company, is Oracle. Let's see if I can pull this one up. And you can see that it was down 6% on the day. And this is also very impactful beyond just this company, but they were at a company event and Oracle talked about the AI build out within their organization. They are anticipating difficulties. So certainly really putting a damper on the excitement around AI as it relates to certain areas. And that's it for this week. I hope you like what you've seen. If you did, go ahead and hit that like button. And again, I'll ask for you to share any questions, areas that you'd like to see covered in future shows. I'd be happy to do that. And for all of you, have a fantastic weekend. I'll look for you here again next Friday.